feel you're draining your finances? I'm going to share 3 ways how not getting whole life insurance is draining your finances. The number 1 way is compound interest. Albert Einstein said, compound interest is the 8th wonder of the world. Those who understand it earn it, and those who don't will pay it. Would you rather have $1 million or 1 penny doubled every day? If you answered $1 million, you would be leaving a lot of money on the table. Because in 28 days, 1 penny is worth over $1 million and will continue to compound for life. Many think compound interest applies to the stock market, but it does not, because the stock market on average loses money 46% of the time. And when you interrupt compound interest, it's not compound interest. So the fact is, whole life is true compound interest with the ability to access it without interrupting its growth. The second way of how not getting whole life insurance is draining your finances is control. One example was the stock market. With the stock market, you give up control when you give your money to strangers to invest it for you. But as mentioned, 46% of the time, they're losing money. Second area of control is banks. When you deposit your money at the bank, you are no longer the owner of that deposit. You become a creditor. And the existence of CDIC deposit insurance should be a red flag that banks are designed to fail, and they do. So the fact is, whole life insurance puts you in control. Every day is a winning session. My Ontario dentist client, his whole life insurance returns over 30 years after fees and taxes were virtually the same as the stock market. Well, I'm about ready to share the number 1 way of how not getting whole life insurance is draining your finances, but the algorithms want me to keep sharing. So let me give you 2 bonus reasons before I reveal the most destructive way how not getting whole life insurance is draining your finances. So the number 3 way of how not getting whole life insurance is draining your finances is erosion. Erosion happens when you borrow from the bank. And when you borrow from the bank, that contributes to inflation, which erodes the purchasing power of your dollar for you and for everyone. It's because of something called fractional reserve banking. Borrowing from your whole life insurance policy, however, does not contribute to inflation. Another way that you erode your money is when you redeem your money. Most people think paying cash is cheaper than financing, but that would be wrong, because cash is the same as financing, because you lose interest that money would have earned had you not redeemed it. Redeeming is like cutting down the apple tree, because the apple tree will continue to produce a bumper crop of apples each and every year. If you cut it down, you stop the production of those apples. So perfect example of how to interrupt compound interest. If we go back to our example of doubling a penny every day, on day 20, that amount of money available is $5,242. And if you redeemed it at that point in time and started doubling a penny again on day 21, the money on day 28 would only have accumulated to $1.28. Perfect example of the destruction of interrupting compound interest. On the other hand, whole life insurance provides lifetime compounding and prevents this interruption of compound interest from happening. In addition, whole life insurance does not contribute to inflation. The number 4 way of how not getting whole life insurance is draining your finances is following the wrong advice. Case in point would be RRSPs. Sounds great, but once you start to really evaluate how effective it is, they end up being tax-infected investments where you always pay more tax in the end than the tax deduction you got. Your investment statements mislead you. Statements showing you have $1 million in an RRSP after tax is only worth around $500,000, which means you have less money for retirement, and you only find that out when you're ready to start to use that money. Another area is this 4% safe withdrawal rule, and that's because many people invest their RRSPs in the stock market. And what happens to the stock market? Well, 46% of the time it loses value. It has a losing session. So because of that, they came up with this 4% safe withdrawal rule, because they want to make sure people don't outlive their money. Well, the fact is, whole life insurance provides more tax-free income than the 4% rule, because it has no losses. Compound interest continually grows. It does not decline like it does with the stock market. The time has come for the most destructive way how not getting whole life insurance is draining your finances, and that is using the banks. It is estimated banks earn around 900% on your money through loans that they make on your deposits. Now, many are not aware you can become your own bank. And You can do that through something called the infinite banking concept that uses the cash value of your whole life insurance policy. That's the capital that continues to earn compound interest that can never be interrupted, allows you to borrow from it without invasive credit checks. Of course, you would then repay that and continue to use it over and over again as your own bank. You won't earn 900% like the banks do, but you will be able to become your own banker and use some of the same principles that the banks use. The fact is, whole life insurance is the only way to control, compound, and use your money so you can stop doing business with the banks. It is the safest storehouse of wealth on the planet. We want you to have what we have, a way for you to create more wealth. If you want to be wealthy, do what the wealthy do. As a certified financial planner, I am obligated to share best practices. The best practice in financial planning is dividend paying whole life insurance and the infinite banking concept. If you don't have it, you're draining your finances. Please connect with us at IBCanadaGroup.com to learn how you can increase your wealth. If you have not yet, please like and share this video. You will be alerted to more great content that is not being discussed often enough.